The stock market. It's this huge part of our economy, a major tool for building wealth. But let's be honest, for a lot of people, it feels like this super complex, walled-off world. Well, in this explainer, we're going to tear those walls down. We're going to demystify the whole thing, breaking down the core ideas, so you can walk away knowing exactly what it is and how it all works.
So, when you hear the words stock market, what comes to mind? Is it intimidating? Overwhelmingly complex? Maybe your head starts to spin thinking about all the jargon, those crazy charts flying across the screen. Look, if that's you, you're not alone. It's a super common feeling, kind of like it's some exclusive club you didn't get an invitation to.
But here's the thing, it's actually way simpler than you might think. Seriously, the core ideas behind it are surprisingly straightforward. So our goal today is to just strip away all that noise, all that confusion, and give you a really clear, solid foundation. Let's start with the most basic question there is.
All right, part one, demystifying the stock market. So what is this thing, really? Let's nail down a solid definition.
Okay, so here's the textbook definition. It's a network of exchanges where investors buy and sell shares of ownership in companies. But what does that actually mean? Well, at its heart, that's really all it is. It's not some single building in New York, it's not one giant computer. Think of it as this huge, interconnected network where tiny pieces of companies are bought and sold millions of times every single day. And this is probably the best way to think about it. It's just a massive marketplace. But instead of buying, apples and oranges, you're buying and selling tiny slices of companies. When you buy a stock, you're not just clicking a button on a screen or buying some ticker symbol. No, you are buying a small but very real piece of an actual business. A tiny slice of Apple or Ford or whatever company it is. You become a part owner. So you might be wondering, why does this whole marketplace even exist? What's the point? Well, it's basically a two-way street that serves two huge purposes. First, for the companies themselves. It's a way for them to raise money, what we call capital, to grow their business. Instead of going to a bank for a loan, they can sell off little pieces of ownership to get cash for new factories, for research, for expansion. And for investors? Well, for us, it's an opportunity to put our money to work, to become a partial owner in these great companies, and hopefully share in their success down the line.
Okay, moving on to part two, how the market works. We know what it is, but now let's get into the nitty-gritty. Let's look at the actual mechanics. Who are the key players, and where does all this happen? So every stock has a kind of life story, and it starts with something called an IPO, or initial public offering. This is a huge deal. It's the moment a private company decides to go public and sell shares to everyday investors for the very first time. Once that happens, those brand new shares get listed on a stock exchange, you've heard of them, like the NYSE or the NASDAQ, and from that point forward, it's all of us, regular investors, trading those shares back and forth with each other through our brokers. Now in the US, there are two big players, the two titans, the New York Stock Exchange, or NYSE, and the NASDAQ, and they actually work pretty differently. The NYSE is what's called an auction market. You can picture it, right? It has that famous physical trading floor where a human specialist, a designated market maker, matches buyers and sellers. It's like a really fast, high-tech auction. The NASDAQ, on the other hand, is a dealer market. It's fully electronic, there's no physical floor. Instead, you have tons of competing market makers who hold an inventory of stocks to make trading happen instantly. This difference is a big reason why a lot of the older, established blue-chip companies are on the NYSE, while the tech world and newer, fast-growth companies really gravitated toward the NASDAQ's electronic system.
Okay, part three. We've been throwing this word around a lot, so let's zoom right in. What is a stock? What does it really mean to own a piece of the pie?
This right here is the absolute key. A stock is your proof of ownership. It's not just a number on a website. It's a legal claim on that company's assets and a right to a slice of its future profits. And honestly, getting this is a huge mental shift. You have to stop thinking of it as just trading numbers on a screen and start thinking like a business owner, because that's what you are.
And just like with ice cream, stocks come in a bunch of different flavors. So first you have common stock. This is what most people buy, and it usually gives you voting rights in the company. Then there's preferred stock, which is a bit different. You usually don't get a vote, but you're first in line to get paid dividends. Then you can sort of categorize them by their personality. You've got growth stocks. These are from companies that are growing super fast, way faster than average. Value stocks are from solid companies that might just be a bit out of favor, maybe undervalued, with the potential to bounce back. And of course, you have blue chips. These are the giants, the huge, well-known companies with a long, solid history. think household names.
All right, Section 4, understanding risk and reward. Now, this is where we have to get really honest. Investing is not a get-rich-quick scheme, I promise you. It's all about a fundamental trade-off. It really is two sides of the very same coin.
So let's look at the investing equation. On one side, you've got the potential rewards. That's your capital gains, when your shares go up in value and you sell them for more than you paid. And then you've got dividends, which is when the company literally hands you a slice of its profits. Sounds great, right? But the other side, the risk is just as real. Your share price could fall. It could even fall to zero. And there's liquidation risk. If a company goes totally broke, the shareholders are the very last people in line to get any money back. That means you could lose everything you put in.
And this chart makes that trade-off crystal clear. Just look at this data from 2010 to 2021. The S&P 500, which is basically a big basket of 500 large U.S. stocks, returned an average of 14.3% a year. That's fantastic. But now look at bonds, a much, much safer investment. They only returned about 2.9%. See the difference? To get that chance at a much higher reward from stocks, you absolutely have to be willing to take on more risk.
This table gives us an even deeper look. So on the left, you've got the average return we just talked about. But on the right, you see risk, and it's measured here by standard deviation. Now, don't let the term scare you. Just think of it as a wobble factor. How much does the price swing wildly up and down? So stocks, the S&P 500, gave us that great 14.3% return with a wobble factor of about 13.4. But then just look at commodities. They had a negative average return over this period, with the highest, most insane wobble factor of them all. Getting your head around this balance between risk and reward is absolutely crucial before you even think about investing a single dollar.
Okay, part 5, Principles of Intelligent Investing. We've covered the what and the how, but honestly, this next part might be the most important piece of the puzzle. It's all about the mindset. How do you approach the market like a disciplined investor and not, a gambler? For the answer to that, we've got to turn to an absolute legend.
This is a quote from Benjamin Graham, who's basically the father of value investing, and it's so powerful. He says, successful investment may become substantially a matter of techniques and criteria that are learnable rather than the product of unique and incommunicable mental powers. Think about what he's saying there. You don't have to be some kind of born genius to be a good investor. It's not magic. It is a skill. It's a set of rules and techniques that literally anyone can learn and apply. How cool is that?
And this right here, this is his core philosophy in a nutshell. An investor should act like a business owner, not a speculator. So what's the difference? Well, a speculator buys a stock hoping the price goes up tomorrow so they can sell it to someone else for more. They're obsessed with the price. But an intelligent investor, they buy a piece of a company as if they were buying the whole dang business. They're focused on the value of that business and how it's going to perform over the long haul. It is a totally different way of thinking.
So here they are, Graham's timeless principles. 1. Know the business. Actually understand how the company makes money. 2. Know the management. Are the people in charge competent and honest? 3. Invest for the long term. We're talking years, decades, not quick flips. 4. Trust your research. You've got to do the homework and then have the confidence to stick with your own reasoning. 5. Focus on value, not what's popular or trendy. And finally, number 6, and this was his golden rule, use a margin of safety. What that means is you buy a stock for a price that's significantly less than what you calculate its real fundamental worth to be. That gives you a cushion, a buffer, just in case things don't go exactly as planned.
When you boil it all down, what Graham is really teaching us is that the biggest enemy in investing isn't some crazy market. It's you. It's me. It's our own emotions, our fear and our greed. The real challenge is about controlling those emotions and sticking to a smart, disciplined, business-like plan. So the question to leave you with isn't, can you beat the market? The real question is, can you control yourself at your own game? Are you ready?